You're about to hear my conversation with Dustin Reid, our Chief Fixed Income Strategist. We talk all about the Bank of Canada's decision to cut 50 basis points in interest rates, also the Chinese stimulus, what's happening in the U.S., and get his views on the U.S. election. I hope you enjoy. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to Market Exchange, a podcast from Mackenzie Investments. My name is Matthew Schnurr, and I'm delighted to be back with our Chief Fixed Income Strategist, Dustin Reid. Dustin, welcome back.
Hey, Matt. Great to be back with you.
We're recording this on the afternoon of the 23rd of October. Earlier today, the Bank of Canada reduced interest rates by 50 basis points. Dustin, love your reaction to both the interest rate move as well as maybe touch on the recent inflation print that was well under the bank's target.
Absolutely, and I think you're right. I think the inflation print, the Canadian inflation print that was out a couple of weeks ago, really got the ball moving. Pre-inflation print market was around 50-50 for 50 basis points, 25 or 50 basis points, so kind of right on the line. It was probably 35 or 38 basis points price, so kind of right there on the 50-50 line, give or take. That inflation print came out and was 1.6 on the annual for headline, which, I mean, there are many things to watch for the bank, inflation and otherwise, but at the end of the day, the bank is a single mandate central bank and supposed to be focused on headline inflation primarily. So that 1.6 is obviously below the 2% midpoint of the target 1 to 3% band. So it did help give the green light, to what you were suggesting before, that the bank would do 50 today. And Governor Macklem had talked about potentially doing 50 in very light words, not necessarily overly direct, but we know from the last press conference at the September meeting when he was asked, I think it was actually the first question in Q&A, did you discuss 25 or 50? And you could tell if you watched the press conference live that, he kind of hummed and hawed over, exactly what to say. And he basically didn't ignore the fact that they talked about 50, but they'd obviously settled on 25. I mean, the data has been not amazing, but not terrible on the Canadian side, even in between the intermeeting period between the September BOC meeting and the October BOC meeting, the one we just had. Now, what I think was confusing or potentially confusing for investors and kind of market watchers was that the labor market data for September that printed in early October in Canada was actually quite strong. And at the time, a lot of people were saying, well, can you really do 50 on the back of that data? But obviously, we got the inflation data after the employment data, and it was very much one-sided. And this is a forecast meeting. The October meeting is traditionally a forecast meeting for the bank, so you had new updates around the growth outlook, inflation outlook, the ever-famous output gap, and not all of those things, but a number of those things seem to suggest that they are concerned about the trajectory of the Canadian economy. And even though they don't expect growth to fall apart next year, and they actually expect inflation in the short term, at least from a central bank perspective, short term, to actually move a little bit higher. But that to me also includes a bit of opportunity, like we are doing in Q3 for inflation and growth, could kind of underperform the bank's expectations again over the next 1 or 2 quarters, both on the growth and on the inflation side. That could make the bank a little bit more open to deeper cuts in the cycle. I think the bank did a very solid job today in terms of delivering 50, did not really disappoint market expectations. A lot of the banks were there. We went into this meeting at 48 basis points in terms of market pricing, 47, 48 basis points. So it really wasn't a big surprise. There were a couple of holdouts, I think, for 25, but most people had moved after the inflation data, and like I said, market pricing was effectively 95% price for 50, so not a big surprise from that perspective.
Great context. What are you expecting out of the bank moving forward? Maybe starting with December, and then give us a sense for your view over the, call it, first half of 25 as well.
Yeah, no, for sure. I think that's definitely the question, and how markets are going to trade here for the next little bit, because again, it was effectively fully priced, so the forward guidance counts a lot. So Just to level set, going into today's meeting, the bank policy rate was 4.25, and then the 50 basis point cut takes the policy rate to 3.75. So okay, so we're sitting here at 3.75, and the bank believes that, rightly or wrongly, but the bank believes that the neutral policy rate for the Canadian economy is a range somewhere between 2.25 and 3.25%. So potentially another 50 basis points lower could get the policy rate to the top end of the neutral range, and then it would be obviously 100 basis points from the current 375 to 275 for the midpoint of the range. The bank, I think, is very concerned about the health of the consumer. Bank's also citing the expectation of slowing population growth next year.
Right.
I mean, I think we'll still see population growth, and most people believe that. It's a slower increase, like slower delta, as it were, and the impact on the economy that could have from a growth and an inflation perspective. And so I think the bank is probably looking to get to somewhere in that neutral range relatively quickly. I think the possibility of a December 50 basis point cut is quite high, and probably higher than where the market is pricing. And when I look through the January meetings, that would be the next two meetings, December, and then the January meeting would be the first one in 2025. I think the possibility of another 50, so that'd be three back to back to back 50s, so to speak. And if we got a second 50 and a third 50, that would get the policy rate to 2.75, 2.75%, which again would be the midpoint of what the bank thinks is the neutral rate. So you're really neither accommodative nor restrictive in terms of your policy rate. And I think that the bank wants to provide that kind of support or underpin the consumer, given what I think the bank thinks could happen, or at least the downside risk, particularly on the growth side, in 2025. So I think 50 and 50 are more likely than not. And when I was looking after the meeting this morning, it is not priced by the market. The market, when I looked this morning, was around maybe 316, 318 for the January meeting. And if it's 50 and 50, it would be 275. So there's a
Right.
bit of an opportunity there if that did come together. I mean, probably more for fixed income and FX and for the currency, and then for equities per se. But that would be significant. But I think when you look at the whole strip, the whole overnight index swap curve, this has been the risk to us for a while. The idea that the bank would need to do A, more, and B, that more gets front loaded. And I think today's 50 is part of that, but early innings. And I think the risks are now skewing towards that scenario coming true. So the market's going to probably need to price in a little bit more in terms of the trough of the cycle into the first half of 25, and that there's going to be more done earlier. It's not going to be as regularly spaced out.
Great context. Why don't we leave Canada behind and go over to China? There was certainly headlines made since we've last talked, at least I guess it's going back 2 weeks or so, with the announcement of stimulus, although it seems like ill-defined stimulus, and markets both rejoiced and then reacted negatively. What's your view on the story out of China, the stimulus? Just love to hear your context.
It's really important, I think, for any investors, global investors, Canadian domiciled investors, to be in tune with what's happening in China. I think the policy moves there, fiscal, monetary, or otherwise, are important from a global macro perspective that can kind of boomerang back to how markets trade here domestically from a risk appetite perspective. And we haven't really chatted on this podcast in a while, but I think late September we had a lot of announcements both on the monetary and fiscal side within a relatively short period of time, a number of days, handful of days, so to speak. Kind of got more in those 3 or 4 or 5 business days than we had maybe in the previous year or so. So that was pretty significant. I think even that in and of itself, without talking specifics yet, is that signal is very important. It seems to suggest that policymakers are trying to level up, I would say, and be taken very, very seriously in terms of the impact that they want to have on the Chinese economy. Kind of drilling down a level or two. There are a lot of little interesting things that I thought were important. So first of all, they cut rates. This is again back late September, and they cut rates 5 days after the Chinese central bank, the People's Bank of China, had a scheduled meeting and did not cut rates. So to come back 5 days later and cut rates again, I think is significant. It shows a signal. Another thing that they did, which I thought was very significant, the key planning body or committee meets many, many times a year. And traditionally, the October meeting is when they, although there are other months as well, but and within later in the year, the October meeting is when they typically announce big economic plans or actions or policy. But this meeting happened in September, and they brought forward a number of policies and announced them in September. When again, September is traditionally not a meeting where this governing body would announce major economic, either fiscal, monetary, or otherwise, uh, plans, mostly fiscal, I guess. And so that was also significant. And then there was a little bit of what I like to call helicopter money, which is kind of a term we use in economics once in a while, which is basically just money directly from the government into households. And the way they did that is basically saying that for every child that a household had over one child, so if you had two children, you would get 800 RMB per month for the additional child over one. And if you had more than an additional child over one, you would also get an additional 800 RMB per month. Anyway, so it worked out to about 14% of households were going to start receiving direct money, like helicopter money. And that is one way to really underpin the consumer in China, which at the end of the day, I mean, the industrial side is obviously very important. And state-owned enterprises are important, and local government balance sheets are important. But at the end of the day, China to kind of reset and really start growing at or above capacity probably needs to engage the consumer a little bit more. So we
Right.
saw kind of 14% of households get direct investment, or like I said, the code term that sometimes we use is helicopter money, and that to me is shows that they are willing to go to that stretch, because that's pretty extreme. People talk about it in Japan a lot when the economy was kind of sputtering, like actually the central bank or the government giving money directly to households to go and spend it to try and get out of deflation and that sort of thing. And so I think that that's significant. It shows that to me, it's not really about the 14%. It's about the willingness and the optics of, oh, we will do this if necessary. So I think that there's a number of significant things there. There've been a couple other things that have happened since then. Probably don't need to get into all the details here. Markets definitely liked it, particularly the Chinese equity market liked
Right.
it right away, and then it kind of fell off a little bit. I mean, it was clear that as we were saying, not everybody, but many, many, many people, whether it's institutional investors or macro funds or the multi-strat funds, were relatively bearish, if not some of the max bearish China. When you had that policy announcement relatively quickly altogether, you can debate how much it should be, but there clearly need to be a recalibration of the
Sure.
valuation of assets, particularly the equity market. So I think, is it a whatever it takes moment? Like, is this a whatever it takes moment for China? I tend to believe that it can be, but I think more needs to be done. I would not be surprised if we see two or three more fiscal announcements happen between now and March that are significant and of size. And there's a lot more detail here, but probably just not necessarily the kind of out of scope for the podcast. But I do think I am constructive on kind of the optics here, and it's not. I mean, it is about the policy, of course, but it's also about the optics, because the optics will tell you kind of what type of policy and the magnitude of that policy going forward. And I tend to believe that this time it is a whatever it takes moment, and it's very serious, and that has significant implications for rest of the world, whether it's commodity prices or reflation trade, or what does it mean for fixed income? What does it mean for Asia equities? What does it mean for the dollar? What does it mean for CNY? Lots of stuff. And I could go on. So I think it's really interesting. I think it's really important. That's why I think Canadian investors should definitely keep an eye on what's happening out of the news flow in China.
You just said that you could go on, and I think I'll ask you to, but maybe direct you more towards U.S., where we've seen yields up. Certainly, a pretty strong macro environment, stock markets reaching new highs. How much is this due to China stimulus and other factors, or what's your overall sense for U.S. economy?
So I think there's a lot of things going on again to try and catch up since we last did this podcast. But the China stimulus is important. I mean, we didn't really hear the word reflation or reflation trade for a while. It had been a while since people had talked about that. Obviously, with inflation coming lower, right? Everyone knows that story. Um, I think that stimulus from China, or at least the attempt of stimulus in China, and potentially a big one, kind of got a few people interested in the idea that, could inflation not necessarily move significantly higher, but could we put in a floor, or could it be kind of asymptotic towards 2.5%, or something like that? But do we need to recalibrate our views on inflation, globally, going forward? And I think that's part of it. I also think that when you look at kind of mid September, right around when the September Fed meeting was, the market was pricing about 250 basis points worth of Fed easing through the end of 2025, through the end of next year. And many people, I would say us included, started to think that that might be a bit overcooked and it needed to come back a bit. And then you had that relatively strong labor market data on the US side this time.
Right.
Again, September data that printed in early October, and it printed a little over 250,000. And you can kind of slice and dice the data and say, well, this is that. Doesn't really make sense. But the market was clearly not prepared for 250K
Sure.
plus print, with the unemployment rate moving lower, closer to 4%. And it was relatively constructive print. And people, again, I'll use the recalibration term because I think it's a good term, including in this instance. And I think the market decided it needed to recalibrate kind of Fed easing through the end of 25, just to put a pin in it. And what does that mean? And we've seen yields back up, so yields higher, prices lower, yields higher in the fixed income space significantly in the last month or so, where 10-year yields have moved well above 4%, and through kind of 410 resistance towards 420, and 30-year yields in the US have moved above 450. And so you've kind of been selling duration, selling the long end of the curve in particular. And that's part of the recalibration. I think also, we can talk about the election if you want, but Trump doing, presumably better in some of the polls, clearly some of the betting markets.
Sure.
And I would say not by a little, but in some instances by a lot, has once again kind of brought us back to June, where could there be a red sweep? And if so, what does that mean for the fiscal story? And could things get a little bit out of hand if there's kind of Republican carte blanche? And what does that mean for the long end? What does it mean for issuance and supply deficits? And what does it mean for yields? And what does it mean for inflation and China tariffs potentially under Trump? And is that inflationary? So we're seeing kind of all those things come together, and 50 basis point moves or 60 basis point moves in fixed income. Depending on the starting point, but in this case, I would say is not small. And you need generally a couple of sparks, and sometimes unexpected sparks, for that to happen. So I think that's been what's happening. Clearly, the non-farm payroll data for October that will come through on November the 1st will be important, although the hurricane impact and some of the strike impact is going to make that a little bit more difficult to kind of clean up and get a true imprint on where the economy is, at least from a labor market perspective. But from a fixed income team perspective, we did fade that, call it that 250 basis point market pricing for the Fed by the end of next year, starting kind of, I'd say, third week ish of September, and have actually been short the long end of the curve, so short duration, not buying duration, but selling duration, and riding that move higher for most of the past 3 or 4 weeks. We've been in and out a couple of times, but generally that's been the direction of travel. And I think here, we're obviously recording here on the 23rd, so 2 weeks yesterday is the election, and then a week Friday will be non-farm payrolls, and we also have a Fed meeting on the 7th, 2 days after the election. So there's a lot of big macro event risk coming up here over the next 2 or 3 weeks, and it's challenging. But I think the direction of travel here, with particularly long end duration higher, makes sense. Although I would say that a lot of it is now priced in. Some people will clearly be looking to fade these levels. But if the U.S. economy continues to improve, or exhibit exceptionalist tendencies, then we could see yields move significantly higher, even though they have moved significantly over the last 3, 4, 5 weeks.
That's really good context. Maybe moving to the election, you referenced it in that response, but maybe we'll get there directly. You referenced betting markets clearly showing an advantage to Trump, probably more pronounced in betting markets than I've seen in at least the poll aggregators, where it's, we call it toss-up territory.
Yeah.
What's your view on that? It seems like Trump has made up a little bit of ground on Harris. What's your overall view, I guess, on the horse race? And then also, you talked about markets reacting to possible or Trump improving. Are markets positioned for more of a toss-up, or do you think they're leaning one way or the other?
I think the price action across asset and a number of securities over the last 2, 3-ish weeks seem to suggest that, I mean, at a minimum, they're pricing out Harris win, and at a max, they're pricing in the Trump win. And you can look at that
Right.
from shape of the curve or the back end of the curve or strength in the US dollar, maybe equities, some sector analysis seem to suggest that the market has swung that way. The polling is, I mean, it's not all one way, and a lot of the polls are still within margin of error. I think if I could say it in one line, I think we've gone from Harris leading a lot of the swing states, or at least competitive in the swing states within the margin of error, to Trump leading or competitive in most of the swing states, but still within the margin of error for the
Got it.
polls. So it's still very close. You've just kind of gone from, let's just put a number on it, like -2% to +2% for
Sure.
Trump, but you're still within kind of a 2 to 3% error band. So I think it's still close, but that's kind of where it is. The most accurate pollster, at least according to the Washington Post, for the 2020 election, TIPP, has Trump higher, last time I saw, by 2 percentage points nationally. And I think we've talked about this before, but generally speaking, most people think that the math for the Electoral College means that Harris probably has to be winning nationally by, I would say, at least 2.5, if not 3 or 4 percentage points over Trump.
Right.
So Trump winning by 2 nationally seems to suggest that he has the edge. But I would say again, turnout really, really counts, and particularly in the 7 swing states plus the 2 congressional districts that can split from the state in Nebraska and Maine. And so it counts, and weather could impact, and getting the vote out really really impacts. Most of the swing states now, swing state polls that I see now have Trump leading. So the betting markets seem to have swung that way, and it's kind of feeding on itself a little bit. One of these betting markets called Poly Market has really opened up,
Yeah.
kind of 66% for Trump, and the remainder for Harris. And I mean, I don't know if it's that much. But it's probably directionally correct. Uh, I've heard a few stories. I mean, I can't quantify it myself, but I've heard a few stories that, I mean, it's not a huge amount of float in the grand scheme of things, huge amount of money that's being bet on, and within these markets, and you kind of have maybe 1 or 2 people over numerous accounts within that betting market ecosystem that might be pushing it a little bit further than it should go. So again, I would always say that betting markets are important, but it doesn't mean that Trump at 66% in a betting market means that he has a 66% chance of winning. That's just where the price that someone's willing to pay, like any other security. In this case, I would say with a relatively smaller float. But I think the market has latched onto this, and it's one of the reasons back end yields are higher. Dollar has been almost straight line. U.S. dollar has been almost straight line higher for weeks on a lot of these on a lot of this narrative. I think that's kind of where the horse race is at, so to speak. I do think there's still trades to be had here. The China trade makes sense to me. Dollar max has also moved significantly higher on the back of all this. Part of that's the dollar side, part of it's the Mexico side on concerns about USMCA. The fiscal, I think, could still, particularly if it's a red sweep, could drive it higher. But I think people have been so Trump winning focused and red sweep focused for the last 2, 3 weeks that debatably it might be getting a little bit overcooked. And there's some value in looking at a minimum Harris, I would say, hedge trades, if not just Harris outright winning surprise trades. And a lot of people are also banking on the idea that if Trump wins, and I have for a long time too, if Trump wins, then it's going to be a down the ticket vote and it'll be a red sweep. Some people are saying now that that's not necessarily true, particularly of the House. And if it is House Democrat, Republican Senate, and then Trump in the White House, the tax policy is going to be, I think, very challenging. Like major tax policy, lowering the corporate tax rate in particular, could be very difficult to, or at least it could be very difficult to get through. And that would be significant, obviously, particularly for equity markets, but I think for all assets. So, I mean, I'm thinking about. We've had a few Trump trades on over the last 3-4 weeks that have done well in the back end, and there's been other drivers like we talked about a minute ago, but the back end duration trade has been clearly one of them. We've had some small long U.S. dollar trades on against euro and Canada, which have done okay. But the duration one's been the big one for us. But now starting to think here with kind of 2 weeks, little inside 2 weeks to go, if hedging some of that on either a mixed split Congress outcome or just a Harris surprise is not a bad idea. So very few people, I mean, said in a different way, very few people are looking at kind of downside S&P puts at this point. Everyone seems to be skewing very, very significant towards upside calls and 6,000 calls and that sort of thing. And so the skew in terms of volatility, I spent a lot of time talking about volatility earlier this year because I think it's extremely important. I think the volatility skew and some of this stuff is definitely favoring downside if you think that there's some mispriced risk there. It's obviously extremely interesting. I'm very focused and very busy on all these things in terms of trying to get the right mix for the portfolio, whether it's just pure alpha and hedging. And but I think it is going to be close. We had 77,000 votes in 16, give or take, and we had about 50,000 votes in 2020, give or take. It's 0.2-ish of the electorate. When you're doing 160 million votes, it's very difficult to call, and you've got
Sure.
a lot of mail-in votes happening this time around, and there's a very good chance that we will not know on the 5th, the 6th, who the winner is, partially because it's going to be close, and then like micro details like Pennsylvania, which I think is arguably the most important state in the union for this election, will not start counting mail-in ballots until the morning of the election.
Right.
So, are they going to finish on Tuesday? Maybe, but I doubt it. So we could be waiting till later in the week before we actually know who it is. So that makes, I think, the market reaction and the uncertainty also another bit of a wrinkle here as we move forward for investors to watch. So lots to play for, lots of interesting stories, no shortage of interesting macro themes here that we're going to be watching over the next month.
Well, that's great. We'll make sure that we get you close to just after the election back on the podcast so we can get your thoughts on the election and everything else that we've talked about as well. So thanks, Dustin, for taking the time to sit down.
That sounds great. Look forward to it. Thanks very much, Matt.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may be associated with mutual fund investments. Please read the fund facts and prospectus before investing. The indicated rates of returns are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.